We have our next guest joining us, Charandeep Singh and Varun Daga, co-founders and fund managers of Girik Capital, now joining us. Gentlemen, good afternoon. Thanks a lot for joining us. Charandeep, one look at your portfolio and it looks like clearly you've taken some outsized bets on some of the recent outperformers. I mean, of course, you may have taken a bet on them earlier, but ICICI Bank and SBI, and these are the kind of stocks which are leading the market, not just financials overall, but these two financials. What's working for them? And do you think the leadership stays with this pocket now going forward?
Yeah, hi Anuj, how are you? Thanks for having us. Good afternoon to you and your viewers. Yeah, I think the answer to that is that it certainly seems that way. Financials have been leading the market, and ICICI has been a big leader for a while. Of course, along with SBI, and a host of other financials, they seem to be doing quite well. They have a significant earnings tailwind because of pickup in credit growth, as you may have seen some headline numbers lately. Pickup in earnings growth as a result of credit growth. And of course, we all know the health and cleanliness of the balance sheet, particularly in these two banks over the last 4 or 5 years, has been quite significant. So they seem to have a good runway to earnings growth, which was possibly not built in and now has been starting to get built into the price.
Gentlemen, hi, afternoon. Charandeep, we were just talking about IndusInd. It's of course, I mean, valuation-wise, IndusInd used to be right up there at one point in time, along with ICICI, maybe not quite Kotak. Kotak was always more expensive. Any sense in looking at tier 2 kind of names here? Because while these stocks are, of course, I mean, these companies have done very well, they've also gotten re-rated, names like ICICI Bank, etc., especially ICICI Bank. Any sense in looking at names like IndusInd?
I must tell you that, as fund managers, we like to focus on leaders and leadership. So if we feel a business, especially in financials, where there's so much paper available and there's so much supply that keeps coming by way of QIBs, well, at least it used to, it probably will again at some point. It's better to stick to the large leaders that are well owned by the institutions and well liked. We have not tracked IndusInd Bank for a long time, so I can't really particularly comment on this, but they seem to go through a similar cycle, like an ICICI and SBI, albeit much later. It was a darling of the markets maybe up to 5 years ago, and then they went through some NPA troubles. But I don't know the particulars and the specifics. We as a fund house like to stick to the leaders. Although I do agree with you, I think there's a lot of value that seems to have emerged in tier 2, tier 3 financials, which are highly ignored. I've seen banks with balance sheet sizes of 1 lakh crore trading at market caps of maybe 4,000-5,000 crore, and their balance sheets have been cleaned up. So for a stock picker, it's a delight. I think there's a good environment out there to go look for some of these where one can make a case of earnings picking up.
Okay, Varun, good afternoon. The other pocket which stands out is autos, right? And you have a stock which has actually done remarkably well, reclaiming its old glory, which is Eicher Motors. What, to your mind, is happening in this space, and is it now getting into a bit of an overcrowded trade? It was, 1 year back, perhaps under-owned, but now is it a bit of a consensus call, you fear?
You could say that in the short run, many of these, in fact, whether it's cap goods or autos, I think there is a bit of euphoria, but I feel the long-term story still remains very intact. You could always get a little minor correction here and there, but I think if one is a strong hand, one should see through that, because I think some of these companies are coming back very, very strong. A lot of, specifically with Eicher, a lot of launches coming up. What they had, their plans to grow in their international markets. I think all those plans are coming on stream. So a lot of excitement out there. So, we would like to stay put. And of course, it's done very well for us. But I don't think the story is over. At least that's what we feel, that the tailwind in fact, the whole auto pack, the tailwind for the next 2 to 3 years is very, very strong.
Tailwind is very, very strong. I got that. Varun, what else? Have you added anything new? Have you added anything, recently, or now that the market is looking, maybe we don't know whether this is the start of a meaningful realignment with global indices, especially the US. What would you look to add in any kind of drawdown situation we may have?
I think the last thing we probably added was like a Zomato, which was a bit of a contrarian call in that sense, because I think a lot of bad news was built in the stock. Everybody was panicking with the losses of Blinkit and the acquisition, and then of course now a bit of sanity is prevailing. And we saw with many of these IT companies where they had their great listings, and especially the tech names, they had a very good listing, and then of course they went through their own cycle. Globally, right, you saw globally many of these tech stocks really got beaten down badly, and we felt that probably this could be a good way, because at least one thing we are very clear about is that the uh, revenue growth will come over the next many years in a company like that. It's a duopoly. We like the business, and we just felt that it was the negative and the panic was overdone. And but we need to still watch out for delivery. We would want that it should deliver, and it should get into it needs to start making money. So that's important. But I think that's a big bet we took, and it's done well for us. It started right after buying, it started doing well for us. So, and for us, we've been completely out of otherwise IT, right? We have no other IT stocks. Of course, this is a consumer tech stock, so you can't relate it to IT services. But we are completely out of IT services, and we've been out of it for a very long time now. So, we thought this is a good space to play it by getting into a consumer tech stock like a Zomato.
Okay, by the way, the markets, the bank nifty is seeing some decent recovery, and that's what it's been the go-to pocket. So maybe I don't know if the low for the day has been made or not, but if you see the nifty and the bank nifty from intraday lows on the nifty now, we are almost sitting at 65-point recovery, but on the bank nifty, I think that's where the recovery is more pronounced. The low was 4,502. And we are at 4791, so almost a 300-point recovery on the bank nifty. Varun, since you referred to delivery, Charandeep, let me take up the next theme. Blue Dart Express. It's a stock that you're backing. It's quadrupled in last 1.5 years, right? Is this a sectoral bet or a company bet that you've taken?
It's a company bet, although I must tell you that the sector is also doing very well. Right? It's a first-order beneficiary of a vibrant economy. It's very dependent on that. So, I must tell you that, of course, we've owned it for a long time now. But we continue to stick with our winners. That's what's normally worked for us. Some of these look like they may have got a little expensive in the near term, but we live with that. As long as the numbers keep coming through and the companies keep solidifying their positions, retain their leadership, we don't have a problem holding on to them. Buying afresh obviously is a different ballgame. One has to be calculated. One has to take advantage of dips and better pricing wherever possible. And of course, the last thing I'd like to add is, none of this should be construed as advice, because, we have bought these in our capacity as discretionary fund managers, and they should not be construed as advice to your viewers.
Charandeep, when do you decide to sell? Is it a valuation? Do you have a price in mind, or you never sell?
No, of course we sell. I think the never sell, yes, the harder part of investing is selling. At least for us, it's been like that. In a fund, you have to be very sharp with your exits. I think we generally like to sell into euphorias. When people are building a hell of a lot into the price of a particular stock, the street is consensus bullish. So, let's, think of maybe, like the pharma cycle when it topped in 2015, and people were building in wild numbers, and sometimes that even if a little goes wrong, you could lose 30-40% very quickly. So you have to be open to booking some profits or getting out at a time like that. So look for, consensus behavior and consensus bets. I would say, financials were probably like that before COVID as well. There were like so many banks making new all-time highs. Money raising was vibrant. Everybody was raising capital. You have to have strong judgment and experience to decide if this is a near-term thing or if it's a long-term top. Sometimes long-term cycles can go on very long. You could be 10 years out of the money. Look at Sun Pharma, you're 7 years out of the money now. You don't want to be stuck in something like that. It's very hard. It's very easy for me to say, very hard to execute. But, many good quality processes strung together, and hopefully you get some of it right.
All right. By the way, I think I spoke a bit too soon. I said maybe the low of the day has been made. It might still have been there. But back to within 20 points of intraday low on the Nifty. Just look at that. And today's decline is being led by some of the leaders like Eicher Motors, Lever, for example, Infosys, Tech Mahindra, these kind of stocks doing well. Now, Varun, you did mention in passing that you don't have IT stocks in your portfolio, and you would, of course, refer to Zomato as a delivery stock or as a new tech stock, perhaps. But why is that? Have you did you not participate on the way up as well, or sort of you exited these stocks when the trouble started? And what's the view now? Are you willing to look at stocks again, given the current fall?
Yeah, so a good question, because I think IT was the first sector that came up on our screener. In fact, IT and metals, I remember, came up on our screeners right after COVID. And these were the two sectors we were betting heavily on. And in fact, a large part of our portfolio was into IT and also some metals. And now we don't have either of them. We have no IT or metals because, we actually... We saw that the earnings acceleration really played out in many of these companies, and the valuation catch up really happened. So many of the companies, just after COVID were, trading at a mid-teens multiple, and then earnings acceleration started because, cost had really reduced for them. Globally, people needed more service. And their orders just picked up even more. So they got amazing earnings acceleration. Margins also expanded, and the multiples also expanded. So you saw some of the companies which we held, moved up very, very well in a very short span of time. In about a year and a half, 2 years, they went up quite sharply. And, we got this sense that, everybody started, what Charandeep said, it had become like a consensus trade. Everybody wanted to have these IT companies in their portfolio. And we felt that the best time, at least in the near term, was done. Valuations were very, very overstretched. The PE multiples had become very, very, it had already expanded. And the next couple of years, we realized that the cost could come back. Your margin pressures will come back, and the earnings which got accelerated will get decelerated. So that's what's happening, is what we feel. These are good companies, great companies, in fact, but we feel that there will be some headwind in the near future, and we can see that in the price.